Following is an educational video prepared by the Maryland State Retirement Agency for our participating governmental units to help them better understand GASB Statement 68. But before we begin talking about GASB's new approach to accounting for pensions, let's answer the question, what is GASB? GASB stands for Governmental Accounting Standards Board and is an independent organization that establishes standards for accounting and financial reporting for U.S. state and local governments. These are the financial reporting standards followed by the Maryland State Retirement Agency and many state and local government entities throughout the U.S. In developing a foundation for this new approach to accounting for pensions, GASB maintains the following basic premise.
Post-employment benefits, including pensions, arise from an exchange between an employer and employees of salaries and benefits for employee service each period. An employer incurs an obligation to its employees for pensions as a result of this employment exchange transaction.
So in plain English, GASB is saying that part of an employee's compensation for a given year includes the pension earned for the year which the employee will receive in the future. The employer has a financial obligation to the employee for this compensation. GASB is now requiring any difference between the Maryland State Retirement and Pension System's assets and projected liabilities, also known as the Net Pension Liability, to be shown on the face of participating employers' financial statements. This is the portion of the pension earned by employees but not yet paid for through contributions or investment earnings. According to GASB, showing the net pension liability on the face of financial statements should allow users to better assess the long-term benefit obligations and the general long-term financial health of a governmental entity. Users should also be able to better assess how well that entity has supported and maintained the pension promises made to its employees. Along the same line, according to GASB, changes in the net pension liability should be recorded as pension expense and included on the face of the participating employer's financial statements. GASB believes this allows users to better assess the period's pension costs for a government's employees since future benefit obligations are viewed as part of the employee's compensation package. This will also provide more accurate reporting by recognizing the pension costs in the same period the employee performed the services to earn that retirement benefit. GASB also believes that consistency and transparency of the participating employer's reporting will be improved by requiring standardized rules, such as requiring a more uniform approach to the determination of the discount rate. This is the rate that is used to value the defined benefit pension plan's retirement benefit obligation. Also, the new standards require that a single method be used to determine the cost of benefits each period. This is known as the actuarial cost method. Finally, the new standards contain specific rules regarding the timing of recognition of certain items into pension expense each period. GASB believes that accountability of the participating employer will be enhanced by requiring additional note disclosures and required supplementary information. To comply with the new reporting standard, participating employers will need to include more disclosures about the pension plan. They will also need to include explanations of how and why the net pension liability changed from period to period. Employers will need to also include a summary schedule regarding the net pension liability information and more detailed contribution schedules. Let's switch gears now and talk about the types of government pension plans GASB's new accounting approach applies to. Statement 68 prescribes reporting standards for both defined benefit and defined contribution pension plans provided to state and local government employees, which meet the following criteria. First, contributions to these plans are irrevocable. Second, plan assets must be dedicated to providing pension benefits to plan members according to the benefit terms of the plan. And last, plan assets must be legally protected from creditors. In this context, the term pension plan includes any plan set up to provide employees or volunteers with retirement income, death benefits, life insurance, or disability benefits. The defined benefit plans administered by the Maryland State Retirement Agency fall within the scope of the new reporting standards. Now let's address the scope of the standard as it relates to the participating employers of the Maryland State Retirement Agency. GASB makes it clear that the new reporting standard applies to any governmental entity who provides pension benefits to its employees and to any governmental entity that is contractually responsible for remitting contributions to the Maryland State Retirement Agency. Employers participating in the Maryland State Retirement and Pension System do both. They offer pensions to their employees, and they must also pay contributions directly to the State Retirement Agency. State and local governments need to comply with these new standards if they issue financial statements prepared in accordance with generally accepted accounting principles. Detailed information discussed in this video is referenced in the paragraphs of GASB Statement 68 as shown here. If you have any questions or comments, please feel free to contact Melody Countess using the contact information shown here. Thank you for taking the time to view this educational video.